we come from a little bit of a different place in the way that we work the markets and work our trades. And what I want to talk about today specifically is about the technical analysis of numbers. And so I want to get right into it and go over a little bit about what that would mean and why you might be interested in following this course, which is very, very different than what you may have been looking at. Our company name is Page Trader, and that is our website there. Let's get into the technical analysis of numbers and what that would mean. We're all trading price. We're all buying and selling in the market, hoping to buy low perhaps and sell high, or sell high and buy low. And the way that we know that our trade is correct or incorrect is simply by numbers, right? We are able to look at the numbers and say, well, we bought the S&P at 2050, and now the market has advanced to 2055. That's higher than it was at 2050, and that results in a successful trade if we take our profits at that time. Have you thought much about the numbers that you trade? I don't think most people do. I think people take for granted the fact that there are numbers involved in the markets. And when the numbers are involved in the markets and you take them for granted, I believe that you're missing a very important factor in what makes markets work. And so what I call the study that I'm about to go into some detail with you for is called the technical analysis of numbers. The technical analysis of numbers. So instead of doing technical analysis on the markets, which are what you're seeing here in front of you, or any market, we're actually going to study the numbers. And so what would that mean? What would that look like to study numbers? And why would we study numbers? Aren't numbers simply a way of keeping track of where the market is? Yes, that is true, but numbers are also the market. The market is actually numbers. So let me start by giving you a couple of examples of how you might start to investigate numbers and start thinking about numbers in your own trading, because it's made a tremendous difference in our ability to do very specific things with markets, because we have made progress in the understanding of how numbers play a part. Now, I want to make sure that you're clear on something, that we're not promoting astrology, we're not promoting numerology, or any kind of mystical thing. We're actually saying, what is a number? And how does a number actually have any part, or does it have any part, in the market itself? Is it merely a way of saying this is where you are right now, you're at 2050, or now you're at 2055, or do the numbers themselves play a part in the market? And I'm going to tell you now that there's no doubt in my mind that numbers themselves are a force of nature that play themselves and become a part of the market itself. They're not merely a measuring stick for the market. They're actually part of the market. So let's go into it a little bit. Let's spend some time with this. And again, I realize this is not going to be the same kind of normal presentation you might be used to, but it's quite different, and I hope it's interesting to you. If it's not, I apologize. But it has made a tremendous difference, and I'm going to show you some examples later of what you can do with this. But just for the time being, let's go through it for a minute, shall we? And let's think about numbers. So let's take a number. We can pick our number 1 through 10, or we could even pick 0. 0 itself is a number. But let's take a number like the number 5, which is halfway between 1 or 0 and 10. So the number 5 has certain qualities to it, doesn't it? The number 5 cannot be divided evenly, as an example, by the number 2. The number 5 cannot be divided evenly by the number 3. So we call 5 an odd number because it can't be divided evenly. So we can begin with the idea that one of the basic differences between numbers is that some of them are odd and cannot be divided and by evenly, and others are even, and they can be divided evenly. So already we have already made a distinction. I know you know this distinction, but we're going slowly here, about all the thousands and millions and infinities of numbers that there are, that some of them are going to be odd and some of them are going to be even. So right there we have a start. Now take the number as an example, 10. When you double 5, and 5 is an odd number, you get to 10. And isn't it kind of odd to you that by simply doubling an odd number, it actually changes to an even number? And it's not only an even number, 10 can be divided by both an odd number like 5. 5 goes into 10 twice, and it can be divided by an even number, 2. 2 goes into 10 5 times. So where we started with an odd number at 5, when 5 gets doubled, it actually turns into something more than simply doubling the number. You would think it would maybe remain an odd number, but it actually becomes what could be called a master number. And the reason we might call it a master number is because it can be divided by both an odd number, 5, and an even number, 10. An even number, 2. But I think one of the things I want you to think about is the idea that although 5 can divide into itself, 5 divided by 5, 5 can now be divided, if you double 5, it becomes 10. And it makes sense, doesn't it, that you could then divide 5 into that. It's double 5, so you should be able to put 2 of those into 10. But the interesting thing is that by doubling the number, you now get to a new kind of number that can now accept an even number divided into it. Whereas 5 on its own could not be divided evenly, 10 can be divided evenly, and 10 is merely doubling the 5. So before we go any further, already there's kind of an interesting little thing going on there, that a number like 5, that when it's doubled, the quality of the number changes. Its capability, if you will, changes. It suddenly can do something when it's been doubled that it couldn't do when it was singular, or at the number 5, the starting point. Now, I'm going to try to tie all this together with market movements, but I want to give you a hint right now. As stocks move higher, or as a commodity moves higher, it is doubling other numbers, just as I just did there. But because of this unusual quality that's built right into math, that allows new capabilities of doubled numbers, the capability of accepting what 5 couldn't. 5 could not be divided by 2. But when you double 5, it can be divided 5 times by 2. It has a whole new quality. So that means as stocks and as commodities rise higher, they take on new qualities that they were not able to do, so to speak, in quotes, at lower levels. New qualities come into play. Now, I'm not going to go into that right now, but I want you to think about that. Now, I hope already this has put some thought going into your head, that numbers there's a very interesting thing going on with numbers. Let's take the number 12 as an example. 12 is also, we would consider that to be a master number. Why? Because it can be divided by 6 and 2. Now, 6 already was a master number, wasn't it? It could be divided by an odd and an even number, 2 and 3. And when we doubled 6, it became 12, and it can be, now it can swallow whole 3 and 4 and 6. So it did take on some new qualities, but not the same as 5 did. So I'm trying to show you that there's a lot of differences and a lot of interesting things happening with numbers that I'm going to relate to the markets in a few minutes here. But before I do, I want to go into a little further stuff for you to think about regarding numbers, because we all take them so, I guess, we just take them for what they are. It looks like they're just a number, just a way of measuring something. But I want to give you an example so you can see that numbers themselves, at least in our work, we consider numbers to be a force of nature, in that they have their own qualities and they express those qualities in certain ways. Let me give you an example. Just not too long ago, almost every new car had a CD player. You know, you can go out and buy the CD. that has your favorite music on it. I know we've moved on to different formats, but let's just use the CD player as an example. So on that CD, let's say you've got opera music, whatever kind of music you like, and that opera music, in order to play that opera music and for you to enjoy it in your car, you would just simply put the CD player in your car and play it. But what's really happening behind the scenes is that all of that operatic music, all of that singing, all of that three-dimensional sound that you hear on the CD itself is actually ones and zeros. We know this, right? This is the computer, this is the binary code. It's just a bunch of ones and zeros. In other words, it's numbers. So here we are again, numbers show up again, and those numbers go through a digital to analog converter. So in order to get the sound out of those numbers, we have to convert them from a string of flat plane numbers into the three-dimensional sound that you hear. It's pretty remarkable when you think about it that those numbers convert into sound. And I want to
Hey, David, I don't mean to interrupt. I just want to make sure that we're supposed to be still seeing the three charts on the screen.
Yeah, we are. I'm sorry. And I just wanted to say I don't have anything showing this, and I apologize that there's no new thing on the chart yet, but I'm going to get to that in a minute. So thanks for bringing that up, though. So the three-dimensional sound that you hear is really started out as a flat plane of numbers and then gets converted through this analog to or digital to analog process, and you hear that. So the proposition I'm making to you is that the movements in stocks and in commodities are not only measured by price, but that the numbers themselves play a very important part in the way the market moves. Not the numbers on the right-hand side of your screen, not just the measurement of where we are, but numbers inherently have characteristics to them that play out. And what we do in our trading and in our forecasting is we utilize numbers in a number of ways to be able to forecast very specific things. Anyone can do it. It doesn't require a guru, and you don't even really have to come to us for it unless you don't know how numbers relate to the markets. And so it's pretty important to get a picture in your mind of how numbers might relate to markets. So I gave you one example with the CD that, numbers are a flat plane, but then through a conversion process, they actually express themselves. So in a way, we could say that the movements of stocks and commodities going up and down to their various numbers are related to key numbers, that there's certain numbers that relate to each market that are going to play themselves out, and that's how we do a lot of our forecasting. I want to give you just a recent example because it just completed today. This is Solar City, and I want to show you a couple of ideas that might be useful to you. You'll notice that Solar City put in a bottom back over here on March 16th, and you'll notice that our forecast began over here on March 23rd, and this was the point where we felt that Solar City could be bought for a further advance to $54. Now, there might be many different ways to know that the market was going to go to $54. And in fact, today's high in Solar City, and this was all published, all of our work is published and broadcast out, was $54.20. How could somebody know that just based on numbers alone? Well, one of the numbers that we would find useful in answering that question would not only be the price level that the market bottomed at over here, but whether it was an odd or an even number. So take a look. Let's go over here. Take a look. The number was 46.69. Now, that is, if you took the whole number, that would be, the whole number meaning $46.69, that would be an odd number. But if we just take the 46, the basic main level that it got to, that's 46, you can divide that by an even number. You can divide 2 into it 23 times, as you may know. When the market moved up and started to advance, and we do use forms of confirmation, we don't just rely entirely on this, but we came to the understanding based on a factor here, one of which was that this was a number that was an even number. The basic number, 46, was even. We can do more in-depth stuff with the 69 cents that you see there, but we're not going to bother with that right now. And we also chose a day that we felt was going to be important to enter this position, again, based on numbers. And I want to point out that that day was, if you count them, 1, 2, 3, 4, 5. It was an odd number of days off of the bottom. So I'm just pointing out some of the things that we did, because this gets a little complicated and it's much easier to understand when you tie it together with all of the information. But the final piece of information that I want to bring up to you here is that there is a factor, which is time, which takes place in the market as well. And time is fixed. It's not something that man can mess with. It's moving at a very fixed rate of speed. Many of our forecasts include a very specific point in time that the market's going to complete a number. So time certainly is very important for you to know the idea of what numbers are. And time is, again, numbers. So one of the things that I'm trying to point out here, maybe not as clearly as I'd like to, is that, because it is kind of a complicated subject, is that price levels, tops and bottoms, and time are all very relatable. And because they're relatable, they can be used to forecast very important junctures in the future where prices are going to advance or decline to. In this particular case, it would have been an advance that the market was going to do. In this middle case here, another one, an advance. This was not something that we actually traded, because we actually wanted to see the market go a little lower here based on our work, but we were looking for the market to go to 109.95, which is about 200 pips in the euro. This just completed yesterday. And the market did go 200 plus pips. It actually went about 250 pips up. This big movement that you see here is there for a reason that's relatable to price and a reason that's relatable to time. And it's not something that you would have to utilize an indicator for, although you might want to use an indicator to kind of maybe confirm what it is that you're thinking is going to happen. And we don't use indicators at this point, but I certainly am not against any form of utilizing indicators. Same thing over here with gold. On April 2nd, looking for a $1,700 per contract advance. Now, that's very important. We're not forecasting exactly, we could have, but we're not forecasting where it's going to go. We're forecasting it's going to go $1,700 or 17 points higher than where it was at this point. It was at 1201. We're looking for $1,700 worth of movement, which would be 1218. And it did get up to 1218, and it certainly went somewhat higher than that. It got up to 1223. All of the factors I'm pointing out to here are part of and parcel to the nature of how numbers interact with other numbers in the market, time-based numbers, price-based numbers. And so a lot of our work spins around all of that, and we've worked out ways to tie this together. Now, the valuableness in this is, number one, I'd like you to start to think more about price and numbers. And I want to give you another visual example, because I don't have a lot of charts. I can go through lots of previous charts that we're going through here, but I think my main interest today was in getting you to start thinking about the numbers themselves. And although it is sometimes difficult for people to try to tie this together, I can assure you that many of the kinds of forecasts that we do would not be possible, if I click through some of these, would not be possible to know these things without having this information. In other words, without having the understanding of how numbers play out in the market. Here yesterday in the S&P, we gave out the indication when the market was at 2060 that the market was going to advance yesterday and complete yesterday, 2077 to 2079. And this, of course, was at 8:55 Central Time, so about 25 minutes after the market opened. And you can see the market spent the rest of the whole day dutifully going up, and it made a high of 2080. And this was forecast, hours before for exactly where the market would go. That kind of certainty is not based on an indicator. It's based on the nature of how numbers relate to the market. Believe it or not, you would not be able to know that information, but at least from our perspective, by any other method that we know of. So I realize that, let's see, I've talked already for about 20-25 minutes. If you have some questions about this, I want to answer them. But the first thing I wanted to say, I've already said, which is to get you to start thinking about the numbers themselves, because there's a lot going on there that you may not have considered. And I want to give you one more visual or mental example that might help you. Let's picture together a swimming pool, and the swimming pool has a known amount of water in it. So the pool is a certain size, it has a known amount of water in it, and through math we can know a lot about that pool. We can know by the size of the pool and by how much water in it how high the pool should be, how high the water should be. And let's take a rubber duck, and let's say we put that rubber duck on the water, and that rubber duck represents the movement of price going up and down. Okay? The water is still right now. The water is not moving, but there's the rubber duck floating there. And now, here comes the part that makes this a little bit more difficult to understand. And let's believe me, it takes us work too. It's complicated, but I want you to think about these ideas, because I really believe that the next level in technical analysis is going to address the things that we're talking about today. Let's just say, for fun, that we took you and hoisted you up above the pool, above the water, and what we do is we know your body mass. We know not just your weight, but the mass of your body. There's a difference. The weight of you is just how much you weigh. The mass is a different number. If we know the mass of you, then when we lower you into the pool, which is also a known, and which has a certain known amount of water in it, predict very accurately where the rubber duck of price is going to rise to, if we know your mass. So when I lower you in the pool, your mass, once it's completely impacted the pool, is going to automatically raise the rubber duck of price to a very specific number. You know, in other words, the water will move up. If we had little hash marks on the side of the pool that represented price, that rubber duck would move higher and touch a certain price based on your mass. And conversely, if we pulled you out of the pool in its entirety, the rubber duck would then go down from whatever price it was down to a known level. And the reason that the levels are known is because we know the size of the pool, we know the water amount in the pool, the amount of water in the pool, and we also know what your body mass is. I gave you that illustration to help you understand that when price moves from here up to here, there, in our world, in the way that we study markets, there is something impacting the market. You could, of course, you can say there's people buying and selling, and that's true. Those people are buying and selling. But the fact that this force that rose the market from here all the way up to here, something impacted the market, and we are measuring that force in order to be able to predict that it would go right to 2079. And just for your information, this forecast, even though it was given out intraday yesterday, right at 25 minutes after the open, I want you to know that it was actually given out in its entirety last week on Thursday, April 2nd, long before the market got even to this point. This was just an intraday trade we gave out. So the market, if we were to bring up let's say a daily chart here, let's do that just for a moment. This is where the market was last week. Let me blow this up so you can see this pretty clear. This is where the market was last week. This was April 2nd right here. That's when we made the forecast. And let me tell you what the forecast was so you can see how numbers are all related. The forecast was, as long as the market stays above 2036, it would advance to 2078 to 2080, and it would do so into early this week, the week of April 6th. So from here, the market went down, and look at the low, 2038. Remember Friday when they had the big crash down on the, the market really wasn't even open, but the Globex went down to 2038. Then yesterday, they made a low of 2038.75, and yesterday they completed the 2080 upside target. And what I'm telling you now, because it's advanced stuff, it's not something that you would just figure out in a couple minutes, nor could I just tell you in a few minutes how to do it, because the how to do it has to do with solving a certain kind of a riddle that the market gives you in every position that it's in. So we were able to solve the riddle at this point on April 2nd. If you ask me right now to solve it, I have to go in and solve the problem. It's like a puzzle, and you have to solve it and come up with the most likely thing that the market's going to do. In this particular case, the most likely thing was, as long as it didn't touch 2036, it would advance to 2080, 78 to 80, into early this week. And indeed, yesterday was early this week, Monday. And this is published, and some of you that are here are probably clients of ours and have seen this. But I'm hoping that you can understand that there's something a lot bigger going on with numbers related to price, numbers related to time, numbers related to where the market actually is than most of us would probably have thought. Because most of all of the forecasting that we do is very much related. This is a losing trade, by the way. We don't always take a winning trade. This was a trade where we had a partial long position, partial exit, and then we got stopped out. Partial exit at a profit, but partial exit. And this ended up being a net loss on this particular trade. And we show all of our trades when we go through this stuff. Here's an example, S&P Thursday, April 2nd. A breakout above 2057 can be bought for advance to 2064 to 2065. So there are numerical reasons that have nothing to do with the ordinary way of measuring the market or kind of calculating the move, and yet the market went up to 2054.75 or 2064, 75, which is exactly where it was supposed to go, 2064 to 2065. All of this is what I'm encouraging to start to study, and think of numbers more than simply a way to identify what price is. Because if you think deeper about numbers and a little bit more, like I told you, think about the harmonics of numbers, the way that I described how numbers get broken down, and when you double them, they take on new qualities and all kinds of things. There's a lot of really interesting things that I've been happy to discover for myself, and there's a lot more. You know, we certainly don't know it all, but the goal of all this is for all of us to improve our trading, no matter what methodology you use, whether or not you use indicators and stuff like that. That's fine. Our goal is, all of us together, is to trade the markets better. Certainly, you would know that the markets are not random, that there is really and truly something going on in the markets that they have to satisfy these certain parameters that they build up themselves. I don't know if I can go into a whole lot more right here, but all of our trade setups that we give out are based upon this. And I want to take a couple questions from you, because my goal today was to introduce you, if you hadn't already been introduced, to the idea of the importance of numbers themselves and how they are, you know, one scientist might tell you that numbers are merely the way that we measure things. The sun is X number of feet from the earth, and so on. But I would reverse that and say that numbers are actually an inherent force of nature by themselves, and that they play out. I mean, many of you use Fibonacci, and so you already know that there's something important with numbers. The way that most of us would use Fibonacci, though, is a very, very basic, if I may say so, way. In other words, just using retracements and so on. Fibonacci, the sequence of Fibonacci, of course, is made up of numbers, and you know that those numbers are important in the market, or they appear to be, hopefully for you. That shows you that there's something very important going on with numbers, but it goes much deeper than simply, you know, looking for retracement levels, which is a very common use of that technique. I do want to see if I can take a couple questions from you, because we have limited time here today. But let's see if I can answer some of these, because there's some questions here. So stay with me here. I hope some of these are for us here. Okay. I don't know if this question is for us, but Danny says, is the 3 a.m. Eastern London time, is that 8 a.m.? I'm not 100% sure. I'm sorry about that, Danny. I don't have a calculation between those, your clock in London and ours here. Does it matter if we're in daylight savings time or not? if you're asking, if that's a question relative to what we're talking about, it does matter if we're in daylight savings time or not. So, and we're not going to be able to go into all the details here, but it does matter. One thing I do want to say, when we're doing our calculations, we're not calculating the weekends. So in other words, there's a principle at work where you would think that since everything else is moving, the weekends would be included in these calculations, but they're not, and they're not for a very good reason. If price is not moving on its own through, and I don't just mean on a very lightly traded Globex, but if we don't have a fully represented market, then that means, a busy, active market, then we're not concerned with the time factor. So as a matter of fact, if there was a whole week that was taken off and the market closed for a whole week, we would not use that week in our calculations. We found that to be very important, that price has to be moving in order for time to be part of that calculation. Let's see. Can you use one order? Okay, these are other questions that were not for me, so I'm sorry. I'm starting to realize that I'm answering questions that maybe you didn't ask here. Let's see. How do you determine the most recent low? It was an early bounce only on daily charts. I'm really just not sure if these are for us. I think these are questions that are probably, I'm going to scroll all the way to the bottom here. Let's see. Stay with me here. Maybe there's no questions. Let's see. Okay, so I don't think we have too many questions that I can find. Very interesting, amazing. I don't think I've heard an actual method to use. Okay, here we go. Thank you. I'm sorry, you guys. I started the way the questions are laid out for me. I'm getting all the previous questions that you maybe gave. Let's see. What is the win-loss ratio? I don't know if that's for us or not. Very interesting, amazing even, but I don't think I've heard an actual method to use. Well, the method that we utilize in putting these numbered forecasts together is something that we've put under the universal name of the roadmap principle. And the roadmap principle is where, through an act of exclusionary work, that means that we're using these numbers to exclude the least likely thing to happen, getting rid of the least likely thing, and that leaves us with the most likely thing that's going to happen. Does that make sense? We're using numbers to get rid of the least likely thing that's going to happen. I just lost my question thing, so let me go grab it again. Give me just a moment here. Let me see if I can pop this out. Stay with me here. There we go. How do you forecast the market using numbers? Give us an example, please. Well, I was giving you an example before that. First of all, you have to understand the methodology, which it would be no way to give that to you here and now because it is complicated and it is like a puzzle. So I want to make sure that you understand that we're not saying that there's some mystical thing that we do with numbers that produces these moves. What the numbers are telling us is what the least likely thing is to happen. And when we know that, we can forecast then what the most likely thing is. We're using numbers to produce the most likely result. And I'll click on a few of these others so you can just see some examples of this. These are all publicly forecast trades. Like the other day, this is not really something we traded here, but soybeans on March 30th, they should test 960 to 959 and then 954 to 953. Look what soybeans did. They started to move down. They started to reverse here. They kept going down. This is a 2-hour chart. And then finally, they spiked way down here to complete that 954, 953. The magic here, it looks like magic, but what it really is we eliminated, by using numbers and by using this technique, all of the least likely things that the market would do, which left us with this thing, that the market would move down to 954, 953, which it did. It made a low of 951. So after the fact, it looks very much like, almost like a magic trick. But in reality, it's a way of it's an exclusionary process that reduces takes away the least likely thing for the market to do based on the premise of these numbers. Here's a 70-pip move in the dollar, which was just a few days back, by the U.S. dollar index at 98.22 for an advance to 98.90. The market was here at the time. the market advanced to $9.90, which is just 10 cents higher than 98.90. Again, this is a great example. The market could have done many, many other things, but we excluded out all of the least likely things the market would do, and that left us, believe it or not, with this being the most likely, based on this premise. So we don't know, like a person with a crystal ball would know, what the market's going to do. We have to determine what is the least likely stuff it's going to do, and that leaves the most likely thing left over based on this whole theory. So I hope you understand that there's no mysticism here. It's an exclusionary process that we utilize that's extremely effective in discovering what the most likely thing the market is going to do. I'm going to take a few more questions here because I know we're got about 6 minutes left here. Stay with me here. Let me see if I can. Question for David Williams: how many trades do your system suggest each month? Well, you know, we have a number of different products. There's basically 3 main products, and probably about, across all of them, probably anywhere between 11 to 15 per week is what we will put out of these types of indications. I also want to remind you that having a forecast and trading the forecast are 2 very different skills. That it you know, after the fact, it looks very easy, but you have to be able to trade it in real time, and you know, it's different in real time, as you all know. But still, the forecasts are what they are, and we do trade them. That's the purpose of our product. Another one, Rhonda says, can this method be applied to any stock or only stocks meeting specific criteria? That's a really, really good question. One of the last things I want to tell you is that every market has a kind of a base number that the market works off of. And once you know that number, then a lot of the future movements of that stock or that commodity are going to be very easy to discern. In other words, you're going to be able to do the exclusionary work and come up with the most likely thing that the market is going to do. However, I have not been able to determine the base number for a number of markets. As an example, silver. We trade in gold all the time, and we're very good at it. But I have not yet determined what the base number for silver is, even though silver is kind of a proxy for gold. It's a very, very different market. So I don't know what that number is. So your question is very good. There are probably some stocks that I'm not comfortable trading, we're not comfortable calling, because of that same reason. So we have to make that first determination about the base number of the market. So I hope that's useful, Ron. That's a really good question. It doesn't work on everything unless you know everything, and we don't know everything. Christopher says, oh, we already answered that, how many trades. 1 or 2 other here, and I'll answer it for you. Does volume matter? Yes, and real briefly here. The market, like everything else around you, is in 3 dimensions. You may not have thought of it that way, but everything is in 3 dimensions. If I said to you, go find me something that only exists in 2 dimensions, you're not going to bring it to me and say, look, I found it. Everything has 3 dimensions. So that means everything that's in 3 dimensions, you and I, tables, chairs, planets, and stock indexes and commodity markets, everything in 3 dimensions has 3 dimensions. There's no way around it. It doesn't matter what it is. Everything in 3 dimensions has 3 dimensions. So this is a very good question. He says, does volume matter? Let me tell you what the 3 dimensions of the market are. Maybe you've never thought about them. Certainly, time is one of the big dimensions because the market has to move through time in order to make these moves. It needs time. That's one of the dimensions. You might think price is a dimension, but you'd be incorrect. Price is merely an expression. It's not a dimension. The dimension is space. In order for you to come from across the room, if they say, hey, Bill, how are you? Or hi, Rhonda, in order for you to come over and shake my hand, you have to move through space to get to me. So space, there's kind of a mathematical space, isn't there, in the markets? Here's the market from going from 2049 in the S&P down to 2043. It has to move through a kind of mathematical space. So space is a dimension. And then volume, the depth of participation, how many people are playing in the market, how much volume there is a dimension. Those are the 3 dimensions of the market. And unless you understand that the market's in 3 dimensions, you could miss an awful lot of really important information by simply looking at only one of them. So yes, volume plays a part in this because it is one of the 3 big dimensions of the market. But keep that principle in mind. Everything that's in 3 dimensions has 3 dimensions. And if you come check us out, I know we're almost out of time. I think we're done in 2 minutes. If you check out some of what we do at pagetrader.com, I'll put our website up here. You can take a trial, no charge, no credit card or anything, and you can watch some of these trades get set up and so on. And you'll be able to see that they're very similar to all the things that we've shown you today, where we're forecasting not only the beginning of the move, but even where it's going and when it'll get there. You'll see trades that will forecast a big move up, and we'll say that price that's 40 points away, that's going to be touched in the 3rd hour of tomorrow. And the 3rd hour of tomorrow comes, and there it is being touched. That type of forecasting is only possible when you move beyond the singular plane of forecasting by simply looking at price and applying an indicator. There's nothing wrong with doing that, but that's simply not all that's available to you. There's much more you can do, and I've been doing this for 25 years. I've dedicated my whole life to developing and understanding what the markets are doing and why they make their moves. And I'm very, very happy that I could show you today and get you thinking anyway a little bit about a deeper solution to the market's movements, and we demonstrate that with our product and with our website. And I'd like to thank all of you for spending your time today listening to me stumble through this and try to describe what's very difficult to put into words sometimes without really laying it out and giving you it all. And even if somebody did sit down and learn this, it would take you quite a bit of practice. It does take practice to do this. It's not a crystal ball. It's a form of exclusionary work using numbers and the 3 dimensions of the market to come up with the most likely route that the market's going to take. And it really does look like magic after the fact. And it really is incredible that it can be done. So I want to thank all of you, and I'd like to invite all of you at your convenience to go to pagetrader.com. We have 4 or 5 products. You can go on the live messenger and watch the S&P. You can take the S&P you can go to the stocks. You can go to futures with crude and gold and all that and watch us put these trades together. And this should be something that you use as a means of getting familiar with our work. You don't have to spend any money at all, but if you want to, you can take the product on and start trading some of these forecasts.